Hello and welcome to today's webinar. Thank you for joining our webinar on tax-efficient exit options for ESOPs. Today's program will be presented by Anthony Sardis, President of Withum Insurance Advisors, and Rick Jaye, Senior Vice President of Business Transition Advisors. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. Feel free to send us your questions during the presentation. We will do our best to address them. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Tony.
Hi, everyone. Thanks for joining us. Just a little background on these presentations and when we want to do them. We typically try to look for ideas that are trending in the marketplace a little bit. One that has come up quite frequently for us is ESOPs, and polling some of our clients as to why and what's going on. Everybody's looking for a transition out of their business, right? If it's a successful business, what do they do when they retire? Everybody's looking for tax efficiency. So how do you transition in the most tax efficient manner? What are all the options that you can put on the table? And then right now, the valuations for businesses have tended to be higher, so it makes ESOPs even more popular. Now, an ESOP isn't necessarily going to be the solution for everyone, but anyone who is considering a transition should certainly look at it and have an option. So with respect to how ESOPs work, if you look at the first slide on number 2, it's an employee stock ownership plan. So the employees do own a piece of that. It's a tax qualified defined contribution plan. When you put money in, similar to 401k, you put it in, what it's worth when you retire is what it's worth. And the next point is very important. It's overseen by the IRS and the Department of Labor. So because of that, we have with us today Rick Jaye from BTA, and I'll let him speak in a moment. But because of that, we try to keep independence very, very, very clean. So we don't want there even to be the appearance of an impropriety, because if it looks like there's, I don't want to use this word, but if it looks like there's sort of collusion, you're a little bit concerned that the IRS could disrupt or have unnecessary reviews of your transaction. So we as Withum, we represent clients, we do audits, we do other consulting for them. So it's usually in our best interest to have outside evaluators come in and do the analysis and implementation of the ESOP for our clients. So because it's a qualified plan under the code, it does get tax benefits, which are extremely valuable, makes the transaction and the company more efficient. And the other piece of it is no business is going to survive without their employees. We can do employee ownership in whole or in part of the business, which will give every employee skin in the game. So as far as where we're going to go now, I'm going to introduce Rick. Rick is, I've known Rick for probably 15, 20 years now. His firm does a great job on ESOPs. I'm going to let him speak about the concept in general and how his company may be different in certain areas on how they interpret the law and the implementation. So with that, Rick.
Tony, thank you. And I appreciate everybody's time. So my sort of intent today is, in the time that we have, is to give everybody a good fundamental understanding of ESOPs and employee stock ownership plan, what they are, in general, how they work, the flexibility. And also, I like to use the adage of, in life, sometimes, especially what we see going on within our country and politics, without taking sides, it's neat to be able to do something well by doing good. And if you believe in sort of that cliche, one of the great things about an ESOP is the fact that all parties that are part of the transaction, from selling shareholders to the local community, to the local support or advisors that are working with those clients, everybody that touches the transaction ultimately does well by doing good. And doing good meaning that you're providing good things to both your company, to your employees, and ultimately to your communities and society. So a couple things going back to the prior slide. And I just want to focus on a couple key points that are important at this juncture to understand. The ESOP is a qualified plan, so like a 401k or a defined contribution plan, it works in a very similar fashion. The differences are under Internal Revenue Code section 4975E-7, which is considered and called the Kennedy-Feingold Law, was put in place after Enron. So we all understand and remember what took place with Enron in Texas with the debacle that ultimately transpired. But the 4975E-7 deals with, in the ESOP trust, instead of having a diversified portfolio, the primary asset is the stock in the underlying company. But it provides certain diversification options and requirements of the company and the ESOP when people ultimately retire, because the ESOP is a retirement plan to benefit the employees. There needs to be resources available, cash resources available to actually redeem the stock, buy it back to pay them out the retirement benefits, which ties into the last point, which is it allows employees to become beneficial owners. For those that are guiding clients, for those that are clients or on the call, the important thing to understand in that last point is one of the critical components of an ESOP. The employees never directly own the stock. They don't control the stock, they don't directly vote the stock, and they don't get access to the financial information of the corporation. It's a misnomer in the industry that the employees, it's kind of like turning the asylum over to the inmates. The board of directors still controls the company, even on 100% stock ownership by the ESOP trust. The employees are entitled to the same benefits they are in any qualified plan. An annual statement that reflects their economic benefit in the form of retirement funds, that would be due to them. The key to the ESOP, though, is that the harder they work, the greater the profitability of the company, the greater the increase in the underlying stock value or the enterprise value of the company increases their allocated retirement benefits. So they now directly have a tie to the success of the company, both from a top line and from an expense standpoint, to drive profitability, ultimately driving the stock value. The harder they work, the more they think like owners, the greater the ultimate retirement benefit will be. So again, under the vernacular of doing well by doing good, the idea of an ESOP, and as Tony alluded to, is we're seeing valuations today at some of the highest levels that we've seen. And we're seeing, regardless of the statistics you get from the employment and unemployment structure in our country, many industries are running at 100% employment. And so a lot of business owners that we work with around the country have actually looked to the ESOP, not just as an exit strategy for themselves of creating liquidity and providing greater diversification, but they've looked at it as an effective way to compete in their market. Because if you're in the construction trade industry, as an example, as an electrical contracting firm, and we've recently closed 4 electrical contracting ESOP transactions just within the last couple of months. Part of the reason why these owners looked at doing those transactions was because in their market, they had opportunities of gaining additional contracts and growing their company. They didn't have the manpower to be able to go ahead and take on additional projects. They saw the ESOP as a way to leverage the company by being able to provide themselves opportunities of recruiting technicians and electricians to their firms, without simply having to continue overpaying from a compensation standpoint to recruit them. And it was a great retention tool to keep those that were there staying on board, that were directly going to benefit from the success of the company moving forward. So I think everybody's going to have access to this presentation so you can go over this, but an ESOP is a way for a business owner to ultimately exit and create liquidity for themselves, one or many, for multiple purposes, from divorces, from partner buyouts. And it's furthermore, as the last point illustrates, it's a way of enhancing employee benefits by creating a significant handcuff to those employees because they're simply benefiting from the ongoing success of the firm. Business owners oftentimes have transitional concerns of, what is important to them and what would be the concerns they have when they're looking to exit. And obviously there's a couple critical ones, which is, how do they receive fair market value for the sale of their company? And the one thing we do know about an ESOP and the way it's structured is it does create the ability of the business owner selling the company at fair market value. And what you're going to see by the economics illustrations, we're going to show up several scenarios. Oftentimes, an ESOP valuation is going to be higher than a valuation when you're looking to sell to a third party, because under Rev Ruling 5960, we're actually able, in the valuation of ESOPs, at looking at the forecast. So if a company has a pattern of growth today, and we can apply that growth, both top line and EBITDA, earnings before interest, taxes, depreciation, and amortization, and we can apply that growth looking 5 years into the future, we actually can present value that future growth and then create a multiple valuation off of that, which oftentimes will get a higher value in an ESOP valuation than you can get in a standard valuation when you're always looking in the rearview mirror. Another concern, which is common that we see from business owners, is obviously the idea of how to minimize the taxes personally and corporately on the transaction. Because as you know, if you sell stock, you've got capital gains long-term, both state and federal, that are a consequence, and depending on the state you live in, the state the business is in, that can be as high as 33%. In an ESOP, what you're going to learn is there's the ability of actually postponing and ultimately eliminating the capital gains, both federal and state taxes, that would be due to the shareholders that sell stock under certain conditions. The other key benefit is the company becomes tax exempt. So we'll talk about the various tax benefits of an employee stock ownership plan and the transaction, but the very nature of it is that it's a very tax efficient vehicle versus any of the other methodologies that you'll learn. One of the key points is what we also find, and a lot of this information comes from firms like yours and market research studies that have been done, but high net worth clients, and even clients that have net worths in the range of $100, $200, $300 million that we work with, what we find is oftentimes the vast majority of their net worth is tied up in illiquid assets, from real estate to their illiquid business ownership. And there's a point in time in life where creating liquidity for those clients is important for planning purposes. And so with Tony and his team, the investment management and the financial planning team within the organization, the planning is a key component as part of an overall ESOP transaction because it provides significant estate planning, investment liquidity planning, charitable planning that comes as part of a transaction. So today we find, because we're seeing valuations at their highest level, depending on the industry, that we've seen in anywhere from 10 to 25 years, anybody that's considering looking at some form of exit planning or liquidity planning in the next 5 to 10 years, now is not a bad time to start considering and looking at your options. And part of the concern of why now is a appropriate time when valuations are high is because we always know in the marketplace, as we've seen back in 2008 with the recession that took place and the economic crisis that really affected across the board almost all industries. So looking at creating an exit today, creating a valuation today provides protection of getting that value at a relatively high level. You also have, as a business owner, industry conditions. So as an example, we did a transaction a number of years ago in the oil servicing industry in Texas. The company at the time we did the transaction, oil was selling for about $102 a barrel. Obviously, when oil went to $142 a barrel, the transaction was quite good. Valuations were still very high. Cash flow was strong. Obviously, with the conditions that took place specific to the industry, when oil dropped to $42 a barrel, that valuation and the transaction at the time it was done looked exceptional. So the key is, again, looking at a timing standpoint of when it's appropriate to look at exiting to create liquidity is appropriate. Now is an effective time to doing that. Also, you've got, as a business owner, you have specific company risk associated with the operations of your business, which really, if we go to the next slide, are faced by every business owner, from employee issues to dealing with key customer accounts. So we find a lot of clients have concentration of clients that they work with. And if you, as an example, are a product provider to Walmart and they make up the vast majority of your business, and as we've seen in the past where Walmart changes various vendors that they work with, it puts your company at tremendous risk of maintaining the valuation. So, and continuing its theoretical survival. So business risks are oftentimes faced as a business owner. They know what those risks are, and not that an ESOP protects you from that risk, but if the intent is looking at some form of when to create liquidity, exit out of the business, and diversify, and transition from being an operating owner of the business to one where you may very well sit on the sidelines and transition over to your management team or family members. Doing so when valuations are high makes sense. What we also want to do is we want to look at the various options because, again, ESOPs are a valuable option, but it's not the perfect option. So, where it works well, but we want to basically focus on, why it's different and why it can make sense, but also look at it as compared to other options. The one thing we do know about an ESOP versus every other methodology of transitioning your business, whether you sell to a private equity as a financial sale, whether you sell to a competitor as a synergistic or a strategic sale to a third party, whether you do an internal management buyout, all of those are purchased with after-tax money. In an ESOP, the one thing we do know under the law is that Congress passed legislation to incent business owners to do ESOP transactions, and we can talk a little bit about why, because the question oftentimes comes up, why are the laws so favorable to support ESOPs? And it really gets down to the foundation of our society. And key questions that come up oftentimes is there risk of tax laws changing to do away with the tax benefits of ESOP? And in reality, ESOPs are one of the few areas of tax law that are supported by both extremes. You've got Bernie Sanders on the far left, who supports ESOPs because it's an idea in his mind of a redistribution of wealth. You're transitioning the equity value from the owners to the employees that will ultimately benefit by an enhanced retirement benefit. And the studies have shown that by the industry of the 8,000 to 9,000 ESOP companies in America, the economic retirement benefit is 3 to 5 times greater than the same companies without an ESOP. So from that perspective, it is a form of enhancing retirement benefits for the typical rank and file employees. On the other side, you've got Sessions, who was a Tea Party right-wing tax advocate, and the tax benefits to the selling shareholders and the tax benefits to the company are significant, which support the transaction. So the options, if you look at an ESOP, first and foremost, is it oftentimes provides the greatest net after-tax net income or proceeds to the selling shareholder, and it's relatively simple. If you don't have to pay capital gains tax up front, depending on your state, it's a tax savings from 20% to as much as 33%, depending on the state you're in. So if you've got a $20 million company, that's anywhere between a $4 million to a $6 million plus tax savings up front. And you're also going to learn about a second option that we call it a second bite of the apple as a selling shareholder of participating in the future value of the company through the transaction. So looking at the economics, fundamentally doing well by doing good, the selling shareholders oftentimes are going to keep more of the money of the value of the company long-term than through any other type of transaction. And if that's important, it enhances the value to your family, to yourself, to charity, whomever is going to benefit from those proceeds. Furthermore, the ESOP utilizes pre-tax dollars to finance the transaction. So as we talked about, every other methodology uses after-tax money to buy the company. An ESOP is the only transaction that allows you to actually purchase the stock of the company with pre-tax dollars, which can be very effective in the way that you're going to actually leverage and buy this company out. It's also an effective way versus an internal buyout, oftentimes, of getting fair market value for the company. So you have a ready and willing buyer at all times who's willing to step to the table to buy the outstanding stock from the shareholders, outstanding stock from shareholders. Remember, this is an employee stock ownership plan, so they're buying the outstanding stock from the shareholders at true fair market value. You also keep third-party interest at bay, because if you've ever had the privilege, and I'm sure those of you at Withum have experienced this, for clients that have not, this is a sort of a learning lesson. Third-party interest, if you sell to a private equity firm or if you sell to a third-party company, oftentimes they have a different mindset than you. Private equity firms are looking for simply one thing, and that's IRR, internal rates of return. They manage assets. They're looking to actually grow the company, either top line or net profits. One of the ways they know they can actually create more EBITDA right off the top is they don't need the same people that you need to operate and run the company, and they don't have the same loyalties to your management team. So you may be gone, your family may be gone, your key executives may be gone relatively quickly after the transaction. And there's no biasness. They're not bad people. I'm just suggesting it's an effective way that they know they can drive profits and EBITDA very quickly to validate that acquisition, even if they can't grow the top line. And that's the same with a third-party buyer, because they don't need 2 CEOs, 2 CFOs, two executive vice presidents of sales and marketing, because they've already got them and they're going to be loyal to those that are already part of their organization. So, and it's an effective way in an ESOP to create a smooth transition to both family and key management if you've got family or managers in the business. So if we now take a look at sort of an economic transaction, this would be comparing an ESOP transaction to either a management buyout or a corporate stock redemption transaction. If you're financing a $20 million purchase out of the earnings of the company at corporate tax rates that have come down, we've got C corporate tax rates that have come down. we have the requirement of earning $27 million in corporate earnings, with corporate taxes estimated state and federally on average to be 26% of $7,027,000 to net the $20 million to write the check to the shareholder. And the shareholder then has capital gains tax estimated to be 29.2, again, taking an average of all states around the country, which is $5,840,000, which leaves a net check to the seller after taxes of $14,160,000. And again, working with Tony, Richard, and the Withum team, there's a lot of charitable planning that can take place that can help to minimize that tax liability. But fundamentally, we look at it, we've got $14 million out of a $20 million sale going to the selling shareholder, and the total tax losses or depletion was almost $13 million. So it's almost a 1-for-1. In an ESOP transaction, on the other hand, because of the tax deduction to buy the stock, the company's earnings would be required of only $20 million to buy $20 million in stock. And if the shareholder qualified and chose to elect what they call a 1042, which is the ability to postpone and then ultimately eliminate the capital gains, state and federal tax, there's no taxes that are paid, so there's no dilution to the $20 million check. Hence, in that scenario, it takes $20 million to buy $20 million in stock, which allows you to theoretically deploy that $12 million in tax losses in other places. So now we have our first question. First question is, an ESOP is a non-qualified retirement plan under ERISA. Keyword here is non-qualified. It's a true or false question. So we'll give you a minute.
Make sure to submit your answer to get full credit. Answers are still coming in, so we're going to give everyone a few more seconds to respond.
A little bit of coaching on this without giving you the answer is, under 401A, ERISA-based plans are qualified plans.
We have a few more seconds for the last few people to start submitting their answers, and we're going to close the poll. The correct answer was false, which 71% of you got.
So we're going to focus now to give everybody a sort of a graphical picture understanding of what an ESOP is and really how it works. So if you think about a company today in implementing and setting up an ESOP, the first thing that they do, just like they establish their 401k plan or their profit sharing or their money purchase or defined benefit plan, the company adopts an ESOP trust, which is a qualified plan. We've got a qualified plan now that has no assets in it. So, and what we're going to focus on today is really what we call a leveraged ESOP. Simply on this slide, if we were going to focus or talk about a non-leveraged ESOP, which is really a rarity in the industry today, but to go through a quick explanation, what the company does in the second slide is ignore that lender component. The company actually funds and makes a contribution up to the 415 funding limit to the plan, which is 25% of payroll. The ESOP now has the cash from the contribution. The contribution was done as a deduction to the corporation, so the corporation gets a tax deduction for the contribution up to 25% of payroll. The ESOP now has that money that it can go ahead and make a market for the stock and buy stock equal to whatever the cash allocation is to buy the stock. That's a non-leveraged ESOP. So as the corporation funds the ESOP trust with a contribution every year, it has the cash that can make a market to buy stock, and those are usually staged over a period of 10 to 15 years, where a selling shareholder doesn't necessarily want to sell all their stock at once, doesn't want to go and leverage the company to borrow money. Therefore, they're able to actually sell stock to the ESOP trust based on the annual contributions. That's simply how a non-leveraged ESOP transaction works. The majority of the industry today and the majority of the companies that we work with, to the tune of probably 98% of them, are leveraged ESOPs. The shareholders want to get cash out of the company in a large lump sum to qualify to fund the 1042 to avoid the capital gains tax and create significant liquidity for themselves and start migrating away from the company. So in order to go ahead and create the capital to make a market for the stock, we go to a third-party lender, typically a bank. There's a number of institutions around the country that we work with that have ESOP lending groups. We actually borrow money. The reason why we do it through the corporation, remember, an ESOP trust simply is a blind qualified plan. It doesn't have the ability of earning capital, and as an ERISA-based plan, it's exempt from judgment creditors. So banks don't necessarily like lending to an institution or an entity that it cannot collect money from. So it makes a loan to the company as what we call an outside loan. The company, in turn, makes a loan to the ESOP trust, simulating the exact loan that was provided by the lender. So those loans are usually amortized over a 5-year period of time. So the ESOP now has cash available. If we go to the next slide. The ESOP can now make a market for that stock. So as an arm's length negotiation, as Tony alluded to, having separation of parties, there's a trustee that is hired by the ESOP trust, independent of the company, independent of the board of directors, and independent of us as an example, as an M&A firm representing the client, who negotiates at fair market value with us, creating a price for that stock agreed to by the seller. Cash then is actually transferred to the selling shareholder. Stock then is moved upstream to the ESOP trust. So now you've got stock in the ESOP trust. The selling shareholder has cash. And upon the transaction, if a qualified replacement trust is put in place, the selling shareholder has 12 months now in turn to implement and qualify for the 1042. The 1042 requires two things. You must sell at least 30% of your stock to qualify to implement the 1042, which is the ability to postpone and ultimately eliminate the capital gains, state and federal long-term capital gains tax. And at the time of the transaction, the corporation must be a C corporation. So in the world of accounting and tax planning, when you're doing ESOPs, there's a great deal of emphasis on the front end, doing structural evaluation to determine what is the best structure to comply with the goals and objectives of the client. So if the 1042 is important, then it's important to evaluate how we can create that C corporation if they're not today, meaning if they're an LLC as a partnership or being taxed as an S corp or they're an S corporation, what needs to get done in turn to qualify to implement the 1042. So two things. You must in turn sell at least 30% of your stock or more, and you must be a C corporation at the time of the transaction to qualify for the 1042. So the key is now, how does the bank and the company get paid back for the loan that it has to the ESOP? Getting back to the way we talked about funding a non-leveraged ESOP, the company makes a contribution to the ESOP, typically equal to or greater than the amount of the debt obligations. So it makes a deductible contribution to the ESOP trust. The ESOP trust then turns around and repays that loan back to the company, who then in turn pays back to the lender. So it's a very simple transaction. An ESOP trust, although it is a qualified plan, as an accountant and as a tax specialist, the question that may come up is qualified plans are not allowed to borrow money and pay interest other than an ESOP trust. It is the only qualified plan under ERISA that is allowed the option of borrowing funds, paying principal and interest for those borrowed funds. So the key is, we talked about one of the key benefits up front of an ESOP trust, which is the employees in turn receive a beneficial interest in the plan. It's important to understand the term beneficial. They don't own the stock, they don't control the stock. They don't have rights to the financial information of the company. That being said, I'm a strong believer in transparency. If the idea behind this is providing the greatest value to your employees and ultimately getting the greatest growth rate of the company, having your employees start thinking as being owners of the company, just as versus just being W-2 workers drawing a salary. The key is the more information you do share about the goals and objectives of the company, profit margins, EBITDA growth rates, top line growth rates, without getting into specifics of the financials of compensation levels to key executives, bonus structures, but the more transparent you are about the general objectives you're trying to achieve in the company and how the company has performed in the past, I have historically seen drives greater success of growth of the company and greater buy-in of building champions within your workforce. But the employees ultimately are entitled to a benefit, and the benefit isn't taking stock when they leave, because under ERISA, there are 4 triggering events upon separation. There's termination, whether it's voluntary or involuntary. There's death, disability, or retirement. The key is in those scenarios, as a retirement plan, this ESOP has to ultimately be able to pay a retirement benefit out equal to the employee's allocated vested benefit, which is the amount of shares that have been allocated to their account times the value of what those shares are worth in that given time frame, times their vested benefit, just like their 401k benefits. The key is, and where Tony and Richard and the investment management insurance team come into play, is in an ESOP that is an S corporation post-transaction that no longer is subjected to income taxes, and we'll get into that next. The corporation can build up cash on the balance sheet, and if we have an entity today that is no longer subjected to paying taxes on its net profits, it's able to, over debt service, build up money on the balance sheet of the corporation over time that needs to be properly invested in either high cash value life insurance investments or in managed accounts, so that that sinking fund is available to redeem and buy back the stock from the ESOP trust as employees receive retirement, severance, death, or termination benefits that they're entitled to. So under those guidelines, cash has got to be available ultimately, just like in a 401k, to pay out the employees their benefit that they're due at the time they have one of those triggering events. We digress a little bit, kind of going into the parameters for the selling shareholder of the 1042, so it brings some clarity of how that works. Is the selling shareholder can elect to indefinitely defer the federal and state taxes, regardless of what their basis is in the organization, if they elect the 1042. We talked about they must sell at least 30% of their stock, and there must be a C corporation at the time of the transaction. The concept that draws similarities is it's very common for those of you that are familiar with 1031 exchanges for real estate or a 1035 exchange in the life insurance world. The client sets up a qualified replacement property trust, and they have 12 months from the date of the transaction to buy stocks, bonds, or debt instruments in other US-based companies. As long as they hold those instruments all the way through death, at death there's a step up in basis, so there is no capital gains tax treatment. The other key is we have a lot of clients that actually elect 1042 that ultimately will look to pay the capital gains tax, but they want to manage it over their lifetime versus having to pay those up front or over the terms of the note that they carry, so that they can actually manage the consequences of their capital gain treatment over time and implement other strategies from a planning perspective to mitigate the capital gain treatment. So they control the payment of the capital gains versus it being dictated, being paid at the time of the transaction. There are also some special investment instruments that have been built exclusively and specifically for the ESOP world. They're called floating rate notes. Tony and his team have experience in understanding that, and they can theoretically work with you. It's part of the work that we do in working with clients of going through and evaluating that. As I alluded to, the three key tax benefits of an ESOP upfront is the 1042, avoiding the capital gains. We talked about the ability of funding the ESOP with a corporate contribution. Corporation gets a deduction for the contribution it makes to the ESOP trust. The third is, which is the most prolific tax benefit of ESOPs, which is if you're an S corporation ESOP post-transaction, and this gets a little bit technical, a little bit complicated, but again, to qualify for the 1042, you must be a C corp. Post-transaction, ideally the corporation will be an S corporation, and the benefit of that S corp is if it's 100% S corporation ESOP, it's no longer subjected to paying any corporate income taxes. And you'll see why as we go through the next couple slides. But the taxation of an S corporation, as you all know, is paid by the shareholders through the K-1 distributions that you receive. An ESOP is a qualified retirement plan. It files a 5500, it doesn't file a 1040. It doesn't file an 1120. So the benefit is, as a filer of a 5500, which is a reporting form and not a tax form, it is not, as an ESOP, subjected to paying taxes, no different than your 401k. So if you have, as an example, Fidelity Magellan mutual fund in your account and you bought it at $110 per share and now it's $140, and you choose to reallocate and transfer that and sell it and buy, let's say, T. Rowe Price's technology fund in your 401k, you've had a gain, but the 401k isn't subject to paying taxes, nor are you, until you actually take a retirement distribution out of the plan at retirement at whatever your tax rate is then. So the key benefit at that juncture is the corporation does not have to distribute income off the balance sheet. Therefore, it's not subject to paying any income taxes for any cash reserves it builds on the balance sheet. Which leads us to now our second question. What does ESOP stand for? You've got 4 questions or 4 responses.
Our answers are A, employee stock option plan, B, employee severance option plan, C, employee stock ownership plan, and D, none of the above. Make sure to submit your answers so you get credit for CPE. Answers are still coming in, so we're going to give everyone a few more seconds. All right, our last few answers are coming in, so make sure to get your answer submitted. And with that, we are going to close the poll. And the correct answer, 87% of you got, it was C, employee stock ownership plan.
Very good. So this gets into sort of the response associated with why, the question oftentimes comes up. A competitor of yours, I did a CPE in Charlotte for as a national accounting firm, and interestingly enough, the senior tax partner questioned me on my last statement about the fact of ESOP companies becoming tax exempt, and because his thought concept, he was very familiar with the 1042, he was familiar with the ability of deducting the contributions to the ESOP, but his question to me was, how does an ESOP company, as a for-profit company, unless you're electing 501c3 status, become a tax-exempt organization? And the next 2 slides, I think, cover that pretty clearly and in a very straightforward fashion. Today, an S corporation, as an accounting firm, you're preparing the corporate tax return, the 1120S. You're creating K-1s that are distributed out and provided to the shareholders of the company that pick that up on their personal 1040s and are subjected to paying taxes on the K-1 income. So oftentimes, the cash flow methodology is the CFO or the business owner will take a distribution, at least necessary to cover the tax liability associated with the K-1 income, picking it up on their personal return, paying the tax liability. The corporation then builds up their AAA account of their retained earnings that helps the company from a cash flow perspective and working capital perspective. In an S corporation ESOP, when you have the S corporation that owns the K-1 is paid to the ESOP qualified plan, nothing changes. The CPA still prepares the K-1, but the K-1 is actually provided to the shareholder, which is the qualified trust, the ERISA-based plan, which files at 5,500, and is able to build up the cash on the balance sheet of the corporation. As long as it makes no distributions of that cash builds up, and there's no subjected taxes associated with it. So the working capital of the company can continue to increase and grow tremendously. What I want you to also think about from a planning perspective is oftentimes when you're working with business owners that have the requirements of, in a lot of smaller companies, 10, 15, 20, $25 million companies that are handled by or owned by a number of shareholders in an S corporate structure, even in a C corporate structure, a lot of the planning work that you're doing as a CPA with your clients is revolving around tax planning, mitigating the client's personal income taxes on the reportable K-1 income. When you're an ESOP and an S corporate ESOP, remember, all your tax planning goes away because the ESOP no longer is subjected to paying taxes. So oftentimes in transactions with a lot of the planning work that we do, companies that have ongoing capital equipment requirements or have a lot of capital on the balance sheet today, the capital equipment is spun off, set up in an family LLC or a partnership. You lease that back to the company, and now ongoing capital equipment requirements you can purchase through that LLC out of the corporation and lease it back so you can start doing some personal tax planning and long-term cash flow planning that can be very effective in the way that you actually help that family in both diversifying, doing future charitable planning, doing future estate planning, and ongoing personal tax planning that can be very effective utilizing ESOP for that purpose. So let's start looking at sort of the tax comparisons of how we create the cash flow that supports the ability of financing these transactions. Because in simplicity, an ESOP is simply a leveraged buyout with significant tax benefits. So if we look in this scenario of a company that's worth $20 million, And today, as an S corporation, if we simply look at that scenario, outside of this 20% exclusion provision with the Trump Tax Act, and we simply look at a company that doesn't qualify. In this scenario, we've got $4 million as an example of taxable income that gets produced in over 15 years. That's $60 million of total taxable income. At a 42% combined federal and state tax rate, that's $25,200,000 of taxes that would be paid by the individual S corporate shareholders, which leaves $34,800,000 of tax-free cash flow, working capital on the balance sheet of the business. If that same company, same scenario, $4 million of annual taxable income over 15 years produces $60 million of cash flow, there's no corporate taxes that are paid or personal taxes, so the company is able to build up $60 million on the balance sheet. If you think about it, you just simply look at the tax savings, in this case of $25,200,000 over the 15 years on a $20 million company, we were able to use 100% of the tax savings at the corporate level to cover and purchase the company and finance that purchase during that period of time from the selling shareholders at no cost to the employees and at no dilution to the shareholders selling the company. So simply put, you're able to deploy and use your tax savings at the corporate level moving forward to buy the company from the selling shareholders and ultimately giving the company and the value of that company, the equity value of the company to the employees. Again, why tax laws favor these transactions is because that value and that economic benefit are ultimately going to provide enhanced retirement benefits to all the employees. And if you grow the company value from 20 million on up, everybody ultimately benefits from that increase in value. This takes a look if a company does comply with the provisions of the tax law that allow them to now reduce their taxable income by the 20%. Same scenario, $4 million of annual cash flow, taxable income, which over 15 years is $60 million. You get a 20% exclusion or $12 million from that. So we're only paying taxes on $48 million. We still at 42% have taxes that are due at $20,160,000. So we have working cash flow of $39,840,000. Again, in the ESOP scenario, regardless of whether you comply with the exclusion provisions or not, we've got the full $60 million of cash flow. So we're able to finance, again, $20 million purchase predominantly out of the income tax savings, purely at the corporate level. When you add on top the personal tax savings of capital gain of almost $6 million personally, we've got a total tax savings of almost $26 million. $26 million finances the purchase between the personal tax savings and the corporate tax savings over time. So this gets into the financing of the transaction because under Dodd-Frank, unfortunately, we can't finance 100% through senior secured lending. So we look at, when we're doing a transaction, we look at getting the most money we possibly can from a primary bank as a senior loan. We do that through bank financing, and then we look through a combination of either seller financing or mezzanine financing as a secondary place to acquire the capital to buy out the shareholders of their entire stock holdings. If you look at the typical structure, when we look at packaging that financing today, banks are going to, in 100% finance transaction sales, we talked about these are leveraged buyouts, and the cash flow should be able to support the leveraged buyout over anywhere from a 7 to 12-year time frame. So that kind of gives you an idea based on cash flow and value, whether the valuation is fair, because you should fit into that time frame at current interest rates to be able to meet that kind of financing obligation. So if we're looking at the foundation of acquiring as much as we can, we usually can acquire between 30 to 50% of the value of the company as a senior loan. Banks are loaning anywhere between 2 and 3 times EBITDA. Under Dodd-Frank, they're limited to no more than 3 times without some significant reserve penalties. So they tend to be compliant with that. And that's all debt on the balance sheet of the business all told. So you're not going to one bank and borrowing at 2 times EBITDA and then going to a second bank and borrowing at 2 times EBITDA. It's all outstanding senior debt on the books of the corporation at that time, all combined. So from that perspective, if we're able to borrow for simplicity 50% through senior secured debt, we're going to look outside to a secondary lender. And in the marketplace, especially here in the Northeast, you've got the hybrid of companies like Blackstone, BlackRock, KKR. There's a lot of firms in that market that will loan to private companies and do a mezzanine bridge loan to provide that secondary piece to take them out. The problem is these are investment firms. They're not loaning at the same rate senior secured lenders are loaning at. So their rates are typically in the range of anywhere between 10 and 12%. They also oftentimes will charge a kicker. In the financing industry, in the private equity world, they call it PICs, PIK, payment in kind. It either is an accrued interest that gets added on the back end, or it can be a stock option or a warrant as an equity position in the company that they can benefit from, up and above the interest rate that they charge. The problem is when you actually model that out from a cash flow perspective, that oftentimes burdens the company with too much cash flow debt to meet those obligations, and you start using 85 to 90 to 95% of the free working cash flow to meet the debt obligations, which is obviously a concern, because if you're burdening a company with that much debt, you've actually destroyed the working capital of the company. Therefore, if they get any kind of a hiccup, you're going to have a default on meeting those note obligations, which is obviously not in the best interest of the employees and not the best interest of the company. So this gets into some of the considerations. So generally, the senior lender does not allow the seller to take a higher interest rate. So when you're looking at mezzanine financing, oftentimes the banks are going to have a big concern, and they're going to limit their exposure, what they're willing to lend on those transactions, when somebody's coming in at that 10 to 12% plus the PIK transaction, diluting the shares even further. So from that standpoint, when we model it out, we look at that, and we work with the senior lenders to get as much as we can to take cash out, because especially today, it's cheap money. But we also then start looking at the cash flow needs of the selling family or the shareholders, and the key is if they're willing to carry back a note and mirror that of the bank, they'll maintain oftentimes their necessary cash flow for family support purposes. You're not burdening the company with too much debt or too much of a cash flow obligation, and it provides the company with the access to working cash flow to continue its obligations to continue to grow. The last point is one I want to focus on because it's a key component. If you go back historically and you look at ESOPs, typically ESOPs were done in phased transactions. Somebody would sell 30%, then maybe sell another 20%, and sell another 20%, and sell the remaining balance usually over a 10 to 15-year time frame. The purpose behind that historically wasn't because of the burden of the debt. It was simply because of the fact that if a business owner as an entrepreneur felt that their company was growing, and every entrepreneur tends to have that mindset. These are companies that they start. Their families started them. They believe in these companies. They are risk takers by general nature in their mindset and personality in parts of their life, and they have tremendous confidence in the success of their companies and believe their companies are going to be worth more in the future. The idea was if the ESOP, and if you look at the reports and all the studies of the growth rate of ESOP companies, which are some of the highest growth rate, highest profitable companies, lowest workman's comp claims rate, lowest attrition rates. I mean, just all of the studies about ESOP companies provide that idea of doing well by doing good for all parties. The concept is the companies grow at a higher rate in the same industry, in the same geographical areas than other companies like them in their market they compete with. So the byproduct is the company will be worth more in the future, most likely. So today, different than in the past, you sold a part of it so you could capture some of that growth yourself when you sold your stock in the future. Today, if you carry back the note, you discount the interest rate to match the bank, you subordinate to the bank, you qualify for that concept I called that PIK, payment in kind, the equity kicker. You qualify for that as a selling shareholder, which means you can sell 100% of the company today, get cash out from the bank note, carry back a note and get interest and principal paid to you over time. And when your note is ultimately paid off, you'll have a warrant, and I'll go through and explain what that's going to look like, but you have a warrant that can be typically between 20 to 30% of the future value of the company that can be redeemed when your note is paid off, which allows you to get a second bite of the apple. So let's think about the math. The company's worth $20 million today, and let's assume it doesn't grow. In 10 years from now, the bank note's been paid off, your note's been paid off, and you control 25% of the company through the warrant. The warrant is exercised at a predetermined price at the future value. 25% of $20 million is $5 million. You got your money up front plus interest. Whether you paid capital gain or not was a choice you made based on the 1042 and whether you qualified and elected that. But you get another $5 million check on the back end. So the key to the transaction is you participate in the transaction on the front end, taking your risk off the table, but you're not giving up the theoretical growth in the company on the back end. So this is what it looks like very simply. I'm going to start accelerating through this because we're running out of time. But the warrant transaction simply allows you in this scenario, if you get a 50% note and a $20 million sale, $10 million paid you up front, and you carry back a note for $10 million, interest for 5 years and amortize for the next 5. and you qualify for warrants equal to 25% of the company, you're going to see a slide that's going to ultimately show you what that means to a client in the form of what the overall benefit is, but it is significant, which is why we say on the front end, ESOPs oftentimes will put more money net of all credited taxes and benefits in the pockets of the selling shareholder than any other methodologies. So another question?
We're at polling question number 3.
An ESOP can be established.
An ESOP can be established with the following structures: A, S Corp, B, C Corp, C, LLC taxed as partnerships, D, LLP, and E, A and B. Make sure you submit your answer.
Answer is no.
And we have a question that comes in. Do shareholders have to sell ESOP in equal % of shares held? The answer is no. And if we run out of time, be sure to submit your questions or email any of the contacts, and we will get back to you after the presentation. We're going to close the poll now. The answer was E, A, and B only.
So if we go to the next slide, and I'm going to accelerate through these because it's pretty self-explanatory, but the warrants, as we talked about, give you a second bite of the apple. From a planning perspective, the last point, warrants can be given and gifted to either key management on an ongoing basis or to family members for significant estate planning. So this is where the planning group within Withum will be able to provide tremendous value, because especially when you're dealing with significant value businesses, the idea of the warrants, which can ultimately in the future be significant in value for companies that have significant growth opportunities, it's a great way of actually mitigating any gift consequences by making a transfer of those warrants where they're, at the time that they're granted, have absolutely no value or very little value, and transferring them out of the estate for gifting purposes. As I explained before, in a $20 million company, here's a perfect example that gives you an idea of what that overall benefit would be to the selling shareholder. For a client that elected the 1042 up front, in this case on a $20 million value company, they got $8 million up front, they got $12 million in principal paid to them on the terms of their note, and interest of $4,524,000, which was a 4.5% interest rate over that term. They qualified for 20% warrants, which provided at a 3% growth rate of the company each year over a 15-year period of time, created a net value benefit of $6,050,000 to the selling shareholder. So the total pocketed funds were $30,574,000 on a $20 million transaction. That's why we say ESOPs oftentimes put more net money in the selling shareholder's pocket than any other transaction you can consider. So the outcome of the summary is pretty straightforward. We talked about owners can sell at fair market value when sometimes there is not a third-party purchaser or you're not a candidate to sell to a private equity or to a financial buyer. And ESOP sometimes can be one of the only methodologies if you want fair market value for the company. It's a way to receive some cash. It's a way to create long-term interest on the notes to the selling shareholders, qualify to defer the capital gains tax or eliminate them, and then participate in the future value of the company to the tune of 15 to 20 to 25% through the warrant transaction that provides estate planning opportunities or charitable giving opportunities, while at the same time keeping the company profits on an income tax-free basis to give it adequate ongoing working capital. So without going into detail on these, because I do want to give time for questions, we get into the ideas of what ESOPs can be used for and some of the key benefits. They provide one of the unique ways of opening up the door to provide some tremendous estate planning opportunities for families that have tremendous net worth in companies where their net worth is tied up in the illiquid stock value, and they want to do long-term either dynasty planning or generation skipping planning to move a significant portion of the current and future value of the value of the company out of the estate. These are for those of you within the organization, these are the sales opportunities for the advisors that come out of a transaction. So everything from the succession planning to charitable planning, something called the corporate repurchase liability. Again, that idea of the stock in the ESOP trust has to be redeemed. The investment management of the insurance sales that come out of the cash flow of the company to build up the reserves of that sinking fund is important. Also, in the non-qualified deferred compensation or phantom stock plans for key executives, along with the investment management that comes out of the liquidity and the insurance sales that come out of liquidity planning. The cross-disciplinary opportunities.
We're going to launch the last question before we go into detail based on the last slide we saw, which is not a cross-disciplinary. asset management, insurance, banking, accounting, marketing. Make sure to submit any questions you may have, or again, you can email any of the contacts for the presentation.
Let's go to just the last 3 pages. We're done.
If we don't have time to answer, we will get back to you in the next day or two personally. All right, we still have a few more answers coming in, so make sure you submit so you can get your CPE credit. Okay, and we're going to close this poll. The answer was E, marketing.
So going to the last 3 slides, because the rest just gets into sort of the cross-disciplinary areas. The profile of the client that you're typically looking for where an ESOP makes sense is, again, you need a client that has a desire to create some cash for themselves and look at an exit strategy anytime over the next 3 to 10 years. EBITDA currently of $1.5 million or greater. They've got a current strong succession management team that allows them to start phasing out, or they're willing to build it. Enterprise value of $7.5 million or more. The reason we set that as a boundary is ESOPs have a cost associated with them, and to finance them, to get cash up front, banks are usually looking for at least a $7.5 to $10 million valuation, and we want every client ultimately to be able to take some cash out of the transaction. And we need at least 20 working employees outside of the ownership structure with $1 million or more payroll. So next steps are pretty straightforward. You've got a team here at Withum. I'd start with contacting Tony and Richard and their investment group. We would begin by doing an educational presentation to the client, not too dissimilar, without going into the detail like we did today. We have a 4-page fact finder we'll make available to your firm, which gives us the idea of the nature of the company, the objectives and the goals. Along, we ask for 3 years of financials on the organization. Our contact information, both Tony and myself. Tony's with Withum, so obviously for those of you part of the firm, you know how to get in touch with him. My contact information is rjaye@bta.boytomallen.us.com. My cell phone number, which is the only way to get in touch with me since I travel Eastern Time Zone daily, is 407-496-0205. Feel free to reach out with any questions you've got. If we've got a minute or two and there's any questions, I'd be glad to address any.
Materials can be found from this presentation, so if you are going through later on and would like to ask any other questions, just email or call either of these contacts, and we'll get back to you as soon as we can. Thank you for attending our webinar. Please remember to take a moment to complete the online survey. Thank you and have a good day. We still have a few minutes, so we'll hang on for any last questions. Otherwise, have a good day.
A common question that we oftentimes get is, we talk about the tax exemption of the ESOP company being an S corporation, but what happens if you've got, let's say, as an example, 5 shareholders, which is a case I'm working on right now. We've got 3 shareholders that are 65 and older that are selling their stock. The 2 younger partners or shareholders are going to maintain their stock ownership today. What is the tax status of that transaction? In that case, we're selling 60% of the stock to the ESOP. 40% is going to be maintained by the existing shareholders. The company would become 60% tax exempt. So you can theoretically still manage the tax effectiveness of the company by the contributions you make. So depending on what the net profits are of the company and what the limitations are in funding up to the 25% of payroll to the ESOP trust, you can still work on minimizing the theoretical tax consequences to that transaction. But the company becomes tax exempt in an S corporation to the percentage that it owns. And you do not have to sell 100% of your stock in the transaction. You must sell 30%, be a C corporation to qualify for the 1042, but that's really the only limitation. Another question that comes up is if we have an existing 401k with a match, do we continue with the match or the safe harbor with the ESOP? So we're a big believer that we want to keep the 401k. And oftentimes, if the company's got an existing match that they're making to the 401k today, we want to keep that for the first year or two. The reason is, if you think about it, if you've got a $20 million company, the example we used, and that $20 million company now leverages itself up with $20 million in debt, senior bank debt, along with seller debt. For all intents and purposes, the stock value is very, very close to zero. So if I'm an employee and I work hard that year and I buy into this idea of the ESOP and I get my ESOP statement and it shows a zero value for the stock or close to zero, psychologically I might say this is great, but what am I getting out of it? So the key is we want to be able to demonstrate to the employees it is a benefit, here's the nature of the way it works, but we don't want to be seen as taking a benefit away. So oftentimes in the first couple of years, we'll keep the existing match until we start seeing the reflective stock value grow, so we can demonstrate to the employees that their economic benefit they're now qualifying for in the ESOP far exceeds what the matching benefit was within the 401k. The reason we want to keep the 401k in place is, in an example that you've got an employee that leaves, you can't force them to take their money out of the plan, but we can force them to convert to cash, to move that cash from the ESOP over into the 401k. And therefore, they're no longer benefiting from the hard work everybody else is doing within the ESOP by no longer being an employee of the organization. So those are common questions. Hopefully that's helpful to you. I want to thank everybody for your time. If there's no questions, we'll close off, and I'll make myself available in the future to your firm, and hopefully continue a strong relationship, working relationship with Richard and Tony, and help you and your clients. So thank you for your time today.